The card declined, not because your account was empty, because a number you didn't know existed had already decided for you. You are 23 years old. You have a job, a real one. Direct deposit every 2 weeks, $412 after taxes, regular as a clock. You have a bank account. You have a debit card that works. You have never stolen anything, never missed a rent payment to a person you actually owed rent to, and never done anything that a reasonable person would describe as financially irresponsible. And the system has already decided what you are worth. Your score is 430. Nobody told you the number existed, and it has been building a file on you since you turned 18. You find out the number exists when you apply for your first apartment on your own. It is a one-bedroom, $690 a month. Not a nice building. The carpet in the photos looks like it has lived a full life. You do not care. You just need a place that is yours. You submit the application on a Sunday night. You refresh your email 4 times on Monday morning before 9 a.m. The reply comes at 11:47. Thank you for your interest. We've decided to move forward with another applicant. You call. The landlord picks up. He says the unit was just taken. You drive past it on Wednesday. The vacancy sign is still in the window. The unit was not taken? You were. The second landlord is more direct. He pulls the credit report while you sit across from him at a folding table in the leasing office. He turns the screen slightly so you can see the number. 430. He says he can work with you, but he will need the first month, the last month, and an $800 deposit. You do the math in the parking lot. $2,180 before you sleep there once. You pay it. Because the alternative is moving back. You need a car to get to the job. The job is in an industrial park that no bus line reaches. You walk into the dealership on a Saturday. The salesman is friendly until the finance manager comes back from the desk. Then the salesman gets quiet. The finance manager puts a sheet of paper in front of you. The rate is 24.9% APR. The car is a 2016 Honda Civic with 81,000 miles. The monthly payment is $419 over 72 months. Total repaid, $30,200. The car costs $14,500. You will pay $15,700 in interest. More than the car costs. Not for the car. For permission to drive it off the lot today. You take it, because you need to get to work on Monday. You sign the paperwork, drive home, and do not think about the number on the sheet for about 3 days. Then you open a calculator app at midnight and do the math again. Same answer. You close the app and go to sleep. Your coworker got his phone on a payment plan with 0 down. You paid $310 up front. You thought he just made more money. He didn't. Your insurance renews in October. You did not file a claim. You did not get a ticket. You changed nothing. The premium goes up by $61 a month. You call to ask why. The representative explains that they re-pull credit scores at renewal and adjust premiums accordingly. You ask when they pulled yours. She says August. You did not know they could do that. At a score of 430, the system is not ignoring you. It is not punishing you. It is simply pricing you, precisely, automatically, without malice, at the rate it assigns to people with your file. The price is embedded in everything: the apartment deposit, the car loan, the insurance renewal, the prepaid phone. You are paying a tax that has no name and appears on no receipt, every month without fail. 8 months later, you have made every payment on time: the car loan, the utilities, the rent, every due date met, not once late, almost. Month 6, your paycheck hits on a Thursday instead of a Wednesday because of a bank holiday you forgot to account for. The car payment was scheduled for Wednesday. You catch it at 11:48 p.m. on Wednesday night and manually transfer from savings to cover it. You do not sleep well that night. The payment posts on time. Nobody knows, but you know. And for 2 weeks after that, you check the account every morning before 7 a.m. just to make sure nothing slipped through while you were not looking. This is what building credit actually feels like. Not discipline. Vigilance. Low-grade vigilance, every day, indefinitely. Your score is 520. You paid off a collection account from a medical bill. An ER visit 2 years ago that you did not know had gone to collections. because the billing department sent the notices to an old address. You found it on the credit report. You paid it. $840 that you saved over 3 months. Gone. The score went up 4 points. 4 points. For $840 and 8 months of perfect payments. You apply for a secured credit card. You deposit $200. The bank holds your $200 and gives you a credit limit of $200. You sign the paperwork. Understanding exactly what is happening, you are borrowing your own money. Because at this point in your life, you understand the system well enough to know that the file needs an open revolving account, and this is the only way to get one. You get a second card. The limit is $300. The APR is 28.49%. The annual fee is $75. You pay the $75 fee, not because you want to, because you have done the math. The cost of not building the file faster is greater than the cost of the fee. You treat it like rent on your credit history. Your friend asks you to move in together, split a 2-bedroom, save on rent. You want to. The building requires a credit check. You tell him you are not sure you will pass. He looks at you the way people look at someone when they learn something surprising and are trying not to show it. You end up not applying. You say you changed your mind about the neighborhood. You did not change your mind about the neighborhood. At 500 to 579, the cruelest part is the gap between effort and recognition. You are doing everything the system asks, on time, every month. Low balances, no new negatives, and the reward is a $200 credit limit, a $75 annual fee, and a score that moved less than a full letter grade in 8 months. But it moved, and that is the only thing that matters right now. Your score crosses 580 on a Thursday morning. The monitoring app sends a notification. You are on your lunch break in a break room that smells like someone's reheated fish. You read the number 3 times. 583. You call the mortgage lender on your lunch break. You have been watching mortgage listings for 4 months. Not because you thought you were ready, because knowing the number makes the goal feel real in a way that it did not before. The lender quotes you 7.8% on a 30-year fixed for a $220,000 FHA loan. Monthly payment, $1,634 in principal and interest, plus $140 in PMI, because your down payment will be under 20%. Total interest over 30 years, $347,000 on a $220,000 loan. You write that number down. $347,000. Then you write down what the payment would be at 7.0% and at 6.5%. You make a column of numbers. You fold the paper and put it in your wallet. You look at it sometimes. The Capital One Quicksilver approves you. 1.5% cash back. No annual fee. Credit limit of $1,000. The first card that has ever paid you anything. You've been paying on cards for 15 months. This one sends you money back. You put gas and groceries in it. You pay it off in full every 30 days. The file is building the right way now. Utilization under 15%. 2 positive payment lines, aging new negatives. There is 1 month where you put too much on the card. Not reckless. A car repair you did not plan for. $430. The utilization jumps to 38%. You panic slightly. You pay it down over 6 weeks instead of 1. The score dips 9 points in that cycle. You watch it come back. It does. 11 points up the following month. You learn something from this that no article told you. The score is elastic when the underlying file is clean. One mistake does not end the trajectory. It just pauses it. You refinance the car loan. The credit union comes back at 13.8%, down from 24.9%. The monthly payment drops by $67. You refinance immediately. Over the remaining 44 months, that saves you $2,948. Not dramatic, but real. The first time the math ran in your direction. At 580 to 619, you are approved for things you could not access before. But approved at this level is its own category. You are in the building. You are not yet on the floor where the good rates live. The elevator requires a different number. You can see it from here. Your score is 641. 2 cards, 22 consecutive on-time payments. 1 collection account aged off the report last month. It had been there for 6 years and 4 months, following you to every application, and now it is gone. You did not celebrate. You just checked the score the next morning to see if it moved. It moved 9 points overnight. You call the mortgage lender. The quote is now 6.9%. Monthly payment on the same $220,000 loan, $1,454. That is $180 less per month than the quote at $580. Not because the house changed, not because the bank changed, because 41 points changed. $180 a month, $2,160 a year. Over 30 years, $64,800. Saved from 41 points on a 3-digit score. You ask for a credit limit increase on the Quicksilver. They approve it without pulling your credit again from $1,000 to $2,000. You do not spend more. Your utilization drops from 19% to 9% in one reporting cycle. The score moves 7 points from that single action. No new money, no new payments, just a ratio that changed. You apply for a conventional loan pre-approval, not FHA, conventional. The lender says you need 10% down. On $230,000, that is $23,000. You have $19,000. You are $4,000 short. You wait 4 months to save the difference. A listing you wanted sells while you wait. You do not make an offer because you are $4,000 short. The home sells for $218,000. It is assessed at $231,000 the following year. You think about that listing sometimes. Not with regret exactly, with something more specific. The understanding that the cost of a low score is not always a higher interest rate. Sometimes it is a house that someone else is living in. At 620 to 659, you are approved for almost everything. The word almost is doing a lot of work in that sentence. Almost preferred. Almost the best rate. Almost ready. The gap between almost and there has a specific price. In your situation, that price is approximately $95 a month across all your current debt obligations. Not for anything you did wrong, just for not being at the next number. Your score is 678. You apply for the Chase Freedom Flex. Approved. 5% on rotating categories. No annual fee. A card from a major institution that would not have looked at your application 20 months ago. The pre-approved mailers start arriving, not the ones that say you may qualify in the small print at the bottom. Actual pre-approvals. You put them on the kitchen counter and look at them. A year ago, you were paying $75 a year for the privilege of having a card with a $300 limit. You close on the house. Conventional loan at 6.4%. Monthly payment, $1,290 in principal and interest on $210,000. PMI of $88 a month until you cross 80% loan to value. You are a homeowner. You tell your parents. Your mother asks what the interest rate is. You say 6.4%. She says that sounds high. You do not explain to her that 14 months ago, you were quoted 7.8 and could not have made the payment work. You just say you think it is fine for now and you can refinance later. You sit in the house the first night, boxes still unpacked, one lamp working, takeout on the floor, and you do not feel what you thought you would feel. You feel tired. And then you feel something quieter than happy. Like a door closed behind you in a room you had been standing outside of for 2.5 years. You refinance the car loan again. Credit union at 7.9%, down from 13.8%. The monthly payment drops by $42. Over the remaining 28 months, that is $1,176 back. The employer at the job you applied for last month runs a credit check as part of the background screening. You find out afterward you got the job. But you find out the check happened, and you spend 3 days wondering if it almost did not. At 678, the result was unremarkable. At 520, you would not have reached the offer stage. At 660 to 699, there is a tier above you that you can almost feel. The gap between your rate and the best rate is approximately $70 to $80 a month. Not for anything wrong. Just for not being at $700. $70 a month. $840 a year. $4,200 over 5 years. That is the price of almost. Your score is 718. You did not do anything dramatic this month. You kept utilization under 15%. You paid every balance in full. Time did the work that time does when you give it clean inputs. The mortgage lender sends an email, not a marketing email, a rate reduction offer on your existing loan. You have been in the house for 11 months. The score has moved from 678 at closing to 718 now. They want to retain the loan. The new rate is 5.8%. The monthly payment drops by $104. Over the remaining 349 months, $36,296 less in total interest. You did not call them. They called you. You read the email twice. Then you close the laptop and make coffee. You do not feel the way you thought you would feel when this moment came. There is no rush, no victory, just a quiet sense that something that used to require effort has stopped requiring it. That is the strange part. The wins at this level don't feel like wins. They feel like an absence. The absence of friction, the absence of the extra deposit, the extra call, the extra explanation. You notice what is missing more than what arrived. The Chase Sapphire Preferred arrives in the mail. You did not apply. It is a pre-approval with a 60,000-point welcome bonus worth $600 in travel. You fill out the application, approved. You book a flight for the first time in 3 years using points you earned from spending you were already making. The insurance renews. Premium drops $54 a month. No claims. No changes to the policy. The score moved, and the premium followed it down. $702 a year returned to your account from a number change. Your coworker asks how you got approved for the Sapphire Preferred. He applied and was denied. You explain the utilization strategy. Keep balances under 10% of available credit, let the oldest accounts age, and do not apply for multiple cards in the same year. He writes it down. He is at 660. You were at 660 11 months ago. At 700 to 739, the advertised rate is your rate. Not the footnote rate. Not the rate that qualifies 8% of applicants. The number on the landing page, that is yours now. Every door is open. No double deposit, no cosigner, no explanation required. The penalty you have been paying since the day you first applied for that apartment has stopped collecting. Your score is 763. Something shifted at this level that did not exist below it. The system stopped being something you navigated around. It became something you used. The distinction sounds small. It is not small. You go to the dealer with a credit union pre-approval at 4.6% in your pocket. You do not ask the finance manager what rate he can get you. You tell him what rate you already have. The conversation changes immediately. The asking price on the car drops $1,100 before you start negotiating the trade-in. The dealer knows you can walk. You have the pre-approval. The pre-approval is the walk. You buy the car. $31,000, 4.6% over 60 months. Monthly payment, $578. Total interest, $3,680. At a score of 430 on a $14,500 car, you paid $15,700 in interest. You are now buying more than twice the car for less than a quarter of the interest cost. Same person, different number. 4 years. You drive home and sit in the driveway for a minute, not because anything is wrong, because you remember the other car. The 2016 Civic. The finance manager's sheet of paper. The number 24.9. You sat in that parking lot, too. Different feeling. You refinance the mortgage at 5.4%. The monthly payment drops another $87 from the previous refinance. You have now refinanced twice since closing, and the cumulative interest savings over the remaining life of the loan are $61,000 compared to the original rate. The credit cards earn you $1,160 in rewards this year. Flights, cashback, hotel points, all on spending you were making anyway. At the beginning of this, you paid $75 a year for a card that gave you nothing. You apply for the Chase Sapphire Reserve. Approved. $10,000 limit. The airport lounge in the terminal you fly through 4 times a year. used to be a door you walked past. Now you scan the card and walk through it. You sit in a chair that costs more than your first security deposit, and you drink a coffee that costs nothing, and you think about the parking lot of that first apartment building, and the folding table in the leasing office, and the finance manager who put that sheet of paper in front of you and did not apologize for the number on it. He was not wrong to charge you that rate. The system told him to. You just did not know the system existed yet. At 7:40 to 7:99, the system has not just stopped extracting, it has started returning. Your score is 821. Oldest account, 6 years and 2 months. 8 open accounts. Utilization, 3.4%. 0 late payments. The credit file is clean in every category the algorithm evaluates. There is nothing to flag, nothing to price, nothing to collect. The mortgage servicer calls on a Tuesday afternoon. Not to collect, not to notify, to offer. They want to reduce your rate proactively from 5.4% to 4.9%. $41 less a month. $14,300 less over the remaining life of the loan. You did not refinance. You did not shop. You did not threaten to leave. They called because retaining your loan at a lower rate costs them less than losing your loan to a competitor. You accept the offer in a 3-minute phone call. You hang up and go back to whatever you were doing before they called. You don't even feel excited. That's the strange part. Not because it doesn't matter. It matters. $14,000 matters. But the feeling that used to come with financial news, the relief, the small rush, the sense of something shifting, it is quieter now, because the system is moving in your favor, has become the baseline. And when something becomes the baseline, it stops feeling like a win. You apply for the American Express Platinum. Approved instantly, no review, no verification call, instantly. $695 annual fee offset in year 1 by credits that stack well past that number. The card pays you to hold it. The Centurion Lounge at the terminal. The room you walked past in year 1 with a prepaid phone and a 24.9% car loan. That room opens now when you scan your card. You walk in, you find a seat, you order the coffee, and for a moment you sit there and you think about the break room. The reheated fish. The monitoring app notification on your phone. 583. You read it 3 times to make sure. You walk into a dealership with a credit union pre-approval at 3.8%. You tell the sales manager before anyone runs your credit. You are not asking what rate he can offer. You are informing him of the rate you already have and asking whether he would like to earn the sale at that number or not. The price drops $1,400 in the first exchange. You do not negotiate further. The number gave you the leverage. You used it once and stopped. At 821, your risk profile is as clean as the algorithm can produce. There is no premium left to extract, no surcharge, no penalty, no double deposit, no prepaid phone, no insurance premium that moved without your permission. The tax you were paying in year 1, embedded in every transaction, appearing on no receipt, named by nobody, is gone. 6 years, score 430 to score 821. 3 things. Then the one nobody says. First, the gap is not abstract. Over 6 years, the difference in total cost between carrying a score below 500 and reaching above 800, measured across car loans, mortgage rates, insurance premiums, credit card fees, and security deposits, can exceed $70,000 for an ordinary middle-income earner. $70,000 paid not for goods, not for services, not for anything consumed. Paid for the position of being early in a history-building process. That money does not come back. But the bleeding stops, and it stops faster than most people expect once the inputs are clean and consistent. Second, the score does not know you. It does not know the collection came from a billing error. It does not know that the month you were late was the month your hours were cut and the timing didn't work. It knows one thing. The pattern of your file over time. You cannot explain yourself to it. You can only feed it clean inputs and wait for the pattern to change. Explanation is irrelevant. Pattern is everything. Third, the oldest account on your file ages 1 month every month. There is no shortcut for this. You can optimize utilization today. You can pay down a balance this week. You can dispute an error this month. What you cannot manufacture is time. Every month you delay starting is a month that will not count toward the account age that matters 5 years from now. The clock does not wait for you to feel ready. And the last thing, the one that is harder to say, the system did not hate you at 4:30. It did not respect you at 8:21. It priced you. Both times. Based on the file, based on the pattern. What changed between year 1 and year 6 was not the system. The system is the same machine it always was. What changed was your position inside it, and your understanding of how the pricing works. You are not a better person at 8:21 than you were at 4:30. You are a better positioned one. And in a system that prices position, that difference costs $67,000 over 6 years. Go get the next point. The clock is already running. And the part nobody tells you, the system never changed. You just finally learned how expensive it is to not understand it.